In this video, I want to share with you 3 economic indicators that I follow. I want to share with you the analysis I do on them, what I'm looking for when I'm looking at them, as well as how they relate to one another. Those are GDP, retail sales, and consumer confidence. For those of you that are new to my channel, my name is Jared Ayers. I am a CFA charter holder. I've been investing for myself for 20 years now. And I've created this channel to share with people who often ask me how I invest, how I think about the economy, how I think about markets, and basically wanted to share with you the ways I do invest and how I do think about these things, and basically the ways in which my thinking differs from conventional industry norms, I suppose. So, before we jump into the actual economic indicator analysis, there are a few things I do want to point out. Firstly, these 3 indicators I'm going to share with you today, as well as all of the indicators I share in my videos, are US indicators. I am based in Canada and I do track indicators for other economies, but because I mostly invest in North American markets, the US economy is the most important economy to me. The next thing I want to point out is that the 13 economic indicators that I track and share are nowhere near enough to understand the complexities that influence investment markets. So the only reason I'm really doing that is to understand what is going on in the economy and what might be happening in the economy on a go-forward basis, which then allows me to basically construct my investment portfolio appropriately for the current economic climate. Knowing that I only have a small window to look into what might be going on also helps me keep my confidence in check and to avoid confirmation bias to some degree. The world is just too complex for me to know and track all of the economic or all of the indicators or variables that influence investment markets, but tracking a few carefully selected economic indicators can help me at least see through the noise and have a basic clue as to what might be going on. Now, let's get into the actual analysis of those indicators. Okay, so the first indicator I wanted to talk about today is GDP. And the graph you see in front of you, this shows GDP quarter over quarter versus the S&P 500, the S&P 500 being the green line, and it goes back to 1998 in this graph, and the blue line being the actual statistic of GDP quarter over quarter, and the orange line being a 4-quarter moving average. So that's sort of something I do usually with the data I capture to try to smooth it out. Sometimes you get a lot of sort of jagged noise, as you can see here, the graph going up and down quite sharply. So what this helps me understand is, on a rolling year basis, is GDP increasing or decreasing, or what is it actually doing? The S&P 500 line just helps me understand what the broader market was doing at the same time as sort of the historical trend of the indicator itself. And then of course leading up to today, I mean this is a little bit dated because this particular graph was done in late December, so all we had was Q3 GDP. Q4 GDP wasn't out yet, so that's why it kind of cuts off right at about the start of Q4. So this indicator is just, as you can see, this is what I'm looking for. I'm looking for, is it, coming down, or is it beginning to change the trend that it's moving in? As you can see, since probably 2016, it's been pretty steadily climbing, even on the blue line, higher highs, higher lows, and so that's kind of what I'm looking at. The next slide here just basically gives us an indication using these red lines as to what the indicator was doing relative to the market. So at what point did the indicator begin to change relative to what was going on in the broader market? You can see this shows that the indicator GDP in particular isn't especially good at predicting, so it's not really a lead indicator. Generally it's usually a lag indicator, meaning that markets will usually react ahead of when the data for this indicator is available. Again, it's a quarterly number, it comes out after the fact, it is backwards looking, but nonetheless this is an excellent indicator because it does give you an understanding of what the entire economy is effectively doing, and it helps confirm for you what the lead indicators might be telling you. So again, and what I've done here clearly is highlight the two main recessions since 1998, the tech bubble, and then the Great Recession, which is effectively 2008 through to early 2009. So again, as you can see here, maybe the market started to move ahead of that actual recession. GDP maybe lagged that a little bit, and then on the flip side though, it is a steady climb, like I said before. Obviously with GDP, this black line is your zero mark, so 2 straight quarters of negative or zero GDP, or negative GDP effectively is what determines a recession. Obviously markets are going to move ahead of that, so you don't want to wait until you've had 2 quarters in succession of negative GDP before you decide what you want to do with your portfolio. At least I don't. So that's why I'm looking to see what the trend is of the indicator in this case. The next indicator is US retail sales. I've chosen to share this indicator today because it does help understand what is going on with GDP. Retail sales in the US is probably one of the largest, if not the largest, contributor to GDP. This is a monthly indicator, so you can see the data points are a little bit tighter. The S&P 500 line is this light blue line, the indicators in blue, and again the orange line is sort of the smoothed out 4-month moving average. So that's what I'm choosing here is 4 months of data historically, to help kind of understand what the indicator is doing. And of course you can see the activity in this indicator a little bit more volatile than GDP itself, but that can also be a little bit of a good thing when you're looking to see when you're looking at an indicator from its predictability standpoint. When we put the red lines on it, you can see where the indicator sort of started to change relative to the activity in the markets. Tech bubble, right at the start of the recession, effectively the retail sales started to come down, but you probably wouldn't have known that for a couple months. As you can see by that orange line, it would have had to kind of break down, inside the recession a little bit, which probably timed close to when the market started to sell off. At the same time, when you look at what went on ahead of the 2008 crisis, you can see that the indicator coming down, then it kind of changes direction for a little bit and then continues to come down again. So if you wanted to draw a general trend line, it's down, but if you started to react, say, back here, then you would have probably missed a bunch of upside as well. So again, another reason why any one indicator isn't reason enough to, for me anyway, to change what I'm doing in my portfolio. I need to see multiple indicators behaving the same way before I'm going to make a move that's going to change how I structure my portfolio. But at the same time, US retail sales, this is also, I'll point out, a year-over-year measure. So what you're trying to do here is sales in December of one year versus December of the previous year, and that helps you remove the seasonality that you'll expect to see in this type of economic indicator. So this is effectively what I'm looking for. As you can see, again, as you're looking upwards here towards current day, it's been higher highs, higher lows. So at the same time, you could be expecting any one of these dips to continue down potentially, but again, looking for what the other indicators are also indicating at the same time before making any portfolio decisions. Next one, this is probably a lead indicator even for retail sales, is the consumer sentiment indicator. This is a survey-based indicator, so this has to do not necessarily with real hard data, but rather people's opinions. So people's opinions can change quite quickly, as you'll see by this indicator, and it's even more volatile, I suppose, than even retail sales, if you look at the blue line especially. So again, not looking at this with a grain of salt, but as consumer sentiment changes, if it turns positive or turns negative, that will have an effect on the retail sales numbers, most likely, which will then be an indicator for GDP. So you can see how the three indicators work together. One is the consumer sentiment being most forward-looking, followed by retail sales, followed by GDP. So again, we put the red lines on this one. You can see the uptrend leading into the tech bubble, and then kind of an about face or a retreat down here. Now this isn't really showing you much different in terms of timing than either the retail sales or GDP. So again, not perfect, but it's an indicator. Again, if everything's behaving the same way, then that's something to be paying attention to. You can see a reversal here partway through the tech bubble, despite the fact that the market continued to decrease. That's always a possibility. And then looking at the 2008 time frame, there was a definite trend down, and which, if you paid attention to, and if enough indicators were also mentioning or indicating the same thing, then that you can see would have been somewhat predictive for the activity in the actual markets. Of course, since then, obviously you can see the sentiment turn as things began to improve, and that even preceded the end of the actual recession. In 2011, you'll remember a bit of a hiccup. Obviously here, sentiment turning drastically the other way, despite the fact that the S&P 500, you can see in behind there, didn't react necessarily quite as sharply, although these are two different scales. The right one being for the consumer sentiment and the left one being for the actual S&P 500 index. But at least, as you can see the trend, this is a very long trend, but you can see there's ups and downs along the way, has been generally speaking higher highs, higher lows. So sentiment has been climbing, as if you look at the actual data points themselves, it's quite obvious. And even despite this sort of sell-off towards the end of 2018, you can still see sentiment is remaining to be high, or remains high, sorry. And of course, if we look forward even from there, we can continue to track this indicator and see how it's been doing. Now, of course, I haven't included that in this graph, but just wanted to show you the relative performance of the indicator to the broader market. So that's basically the three indicators I wanted to share with you today. They are very they give a small piece of the puzzle, and they need to be taken in conjunction with the other indicators. Despite the fact that consumer sentiment is a leading indicator for the other two, you still need to be careful about looking at these indicators before making any investment decisions. So like I said, those are the three indicators I wanted to share with you today, and how I look at them, how I analyze them. So if that was helpful, please let me know. If it wasn't, please let me know. Like the video if you do like it, subscribe if you want to hear more, and please, by all means, comment, tell me what you like, didn't like, and what you'd like to see me cover in the future. Until next time, thank you very much for watching.